Hey everyone, this is Andy Michael, Chief Investment Officer of Seven Springs Wealth Group. Hope everyone's having a great summer. Today I want to share with you what we're seeing as we wrapped up the first half of the year and we start taking a look towards the second half of this year. So if you recall, our big theme this year has been rates and profits. We know last year we had lower interest rates and strong profit growth. Was that going to carry into this year? Or would we see some type of divergence? And what type of impact would that have on markets? So if we recall, we had three big themes coming into this year. We had those strong profit growths. The market thought that there would be lower interest rates coming into this year. And we expected that there would be some midterm US stock market volatility. On average, the volatility in the market in the year two of a presidential cycle, the midterm, is the greatest of all four of presidential cycle years. And so let's check on the health of each one of those. Profit growth by far has been superior to even the good profit growth that analysts were projecting going into the year. So we started with a 14% growth. Now we're estimating 24% profit growth for the year. So that's very much on track. Lower interest rates, on the other hand, is a different story. Not only have interest rates not declined, they've actually increased, both on the 2-year Treasury yield, the 10-year Treasury yield, and the expected federal funds reserves rate is now going from expecting cuts this year to one hike is the base case projected for this year. So that is not gone as the market would have projected. We'll talk about that a little bit more in a moment. And midterm US stock market volatility, at this point, I put a circle there. We're just saying that is yet to be determined. Really, the second half is when we would expect that midterm volatility that might come. And so more to come as we move on into the year. If we look at the first half performance, and we have these ranked from the best performer to the worst, a couple points. First off, everything on this slide here is positive. So what a great start to the first half of the year. The second thing I would say is this is one of the cleanest tapes, if you will, of risk and return, that the risk you take is actually corresponding with the return you've received. So you think about risk, emerging markets, then small caps, global equities, large cap stocks, international developed stocks, real estate, high yield bonds, investment grade bonds. The more risk you took that the market traditionally thinks of as risk, the better return you received. So very, very clean performance and positive returns really all across the board to start the year. Turning our attention, though, looking below the headlines. So what's going on underneath the hood of some of these big markets, the US stock market in particular, we've seen a very different story. On the right-hand side, we have the implied correlation index. What you want to take from this, when you see it spiking, like it was spiking in end of March when the war in Iran was really starting to peak, all you expect stocks are all moving in the same direction. So look at where we are today. Stocks aren't expected to move in the same direction at all. We've had significant divergence and dispersion within the stock market this year, greater than we've seen in years past. On the left-hand side, you can see what I mean. So the technology sector in particular this year with the AI infrastructure build out has done very, very well, up 33% through the end of the first half. But look at what also is participating. Again, just some examples to show what's going on underneath. Transportation stocks are doing well. Bank stocks are doing well. We looked on the last slide, small cap stocks are doing well. That's a very healthy typically indicator that's saying these more cyclical, more risk on type investments are performing very, very well to start the year. But I think that the bottom half is just as interesting. If you look at the S&P excluding tech, so everything in the market except for tech, it's up 5% this year. You double that, that's close to 10%. So that's a great return. But compared to what's happening in tech, it feels much more muted. And with that, the volatility is much more muted in those names too. If we look at the Magnificent Seven, so there's an ETF that trades on those 7 companies alone, down 2.5% this year. So if you had looked at the slide before, the market's up 10%, the S&P 500. I would have certainly gotten wrong at the start of the year that then the Magnificent Seven that make up nearly a third of that market are down 2.5. So that really speaks to the broadening and the depth of this market. It's not just being driven by seven companies alone. In fact, it's those companies are detracting from the market this year. They're really enabling, their spending is enabling, which we'll talk about in a moment. And gold and Bitcoin, again, had huge runs last year, are actually down year to date. So a lot of dispersion in the market this year. Moving on, a little bit under the hood again of those hyperscalers and that AI build out. Why are some of those Magnificent Seven companies down? On the left-hand side, we show the free cash flow they were projected to make, about $300 billion a year ago, to where it stands today, $50 billion. Why? They're spending their cash. They're spending their cash on this AI build out. The market's taking notice. They're not rewarding the share prices of the spenders. They are rewarding the share prices of the receivers of that spend, but they're not rewarding the spenders at this point in time. They're taking more of a show me approach. They want to see a return on that investment. On the right-hand side, we're now taking a look. How is the return on that investment starting to look compared to the depreciation of that investment? And so we have AI generated revenue compared to CapEx depreciation. What I want you to take from this slide is something encouraging and something that has to happen to defend all of this spend. So the gray is the revenue being received by AI, think LLMs, and the blue is the depreciation that you're writing off on that investment each quarter. And now we're starting to see that revenue is in fact outpacing the depreciation. We know the depreciation is going to go up because the spending's happening. What we anticipate and the market thinks will happen is that the revenue will keep pace. But that's a chart that we're closely watching. But so far, at least, there is a good start to that. There is revenue that's more than offsetting the investment as far as the depreciation goes of that investment. Turning our attention to oil and inflation, there's a lot of news and noise around inflation right now. So I like to think about it zooming out a little bit, and I like to think about it from a longer term perspective and future thinking. So I'm looking here at the bottom at the 5-year break-even inflation rate. So this is what the market anticipates inflation will be over the next 5 years. And what we can see is at this point, the expectation for inflation over the next 5 years is actually at its low point for the year. So that's an encouraging sign to me. And you can almost see it matches perfectly with what's happened with oil prices. Since the war in Iran initially started, we have effectively round-tripped the price of oil in that time. So we still may have quite a bit of noise around inflation. Again, every time there's an inflation print that's looking in arrears, it's not looking ahead. This indicator is looking ahead. And again, a little bit of comfort there that the market thinks that inflation expectations have actually gone down since the start of the year, and in particular from 3 months ago. Looking at interest rates, I really think this is important. You hear a lot about the Fed, you hear a lot about interest rates, you hear a lot about inflation. Warsh, the new Fed chair, has just taken appointment, has taken a little bit more of a hawkish tone than maybe what the market initially thought. I think it's important here to step back and really look at the rate of change in interest rates. In 2022, both the 2-year and the 10-year, they went from roughly 1% to 5% in a very short order of time. This year, they've gone from around 3.5% on the 2-year and 4% on the 10-year to around 4.1 on the 2-year and 4.5 on the 10-year. Those changes are minuscule compared to what we lived through 4 years ago. So to me, this is a non-issue in a global macro perspective. This is actually a relatively benign and consistent interest rate policy regime that we're in. If we're debating one cut versus one hike or no cuts and no hikes, that's as consistent and steady of an interest rate regime that we've seen in a long, long time. And so I kind of like actually where rates are right now. It's not too hot, not too cold. Savers earn a real yield, but it's not too restrictive for borrowers to start a business or get some type of loan. So overall, I think we're still in a pretty good place with interest rates. And so long as they're contained in this relatively small band, I think that there's not too much to be concerned about here. Going back to what our excitements and concerns are, I've highlighted what has improved or worsened over the last 3 months. So I'm really going to focus there. Otherwise, this is unchanged from the start of the year. So we definitely saw that revenue, profit, and margin growth are all looking very, very strong, even better than we thought. Rates, as we just discussed, aren't lower. Financial conditions look fantastic. I mean, we can see what capital markets are doing with some of the IPOs that have come out, the bond issuances that have come out, the additional equity issuances that have come out. The conditions are very, very ripe to be able to raise capital right now. So that overall is improving from where we were last year. Market breadth, we just looked at that. What a great time to own small cap companies, international companies. Again, not owning just the Mag 7 alone. That breadth has really played out beautifully this year. Another red one here, corporate share repurchases. Again, we just saw all that cash flow come down from those big corporate buyback companies. Now they're not only not buying back stock, some of them are even issuing stock. So that was one of those buyers in the market that we're seeing less of than we were last year. Starting valuations have gotten better. Funny enough, if profit growth is expected to be 24%, and yet we were only appreciated 10% for the year on the S&P 500, valuations are actually coming down. They're not going up. So that's a very positive sign. Unemployment's looked good. Inflation's looked a little higher, so a little bit of an offset there. Geopolitical risks I've labeled as improving. And again, this is from 3 months ago. 3 months ago, the story and narrative that was gripping markets, and we were hanging on every tweet of Washington officials. Very different story today than when we were then. There are certainly still a lot of geopolitical risks out there, but from the market's perspective, that has absolutely improved over the last 3 months. And the last one I want to mention is, again, we have seen debt starting to increase to help fund some of this capital expenditure in the AI build out. All the other ones we're still keeping an eye on, both excitement and concerns. Just no major updates from us at this point in time. So the good news is that the investment strategy that we laid out to the start of the year, I think, is more applicable than ever. You want to diversify beyond U.S. large cap. We've seen that over and over through all these slides we just went through, how well and how much importance it is to have assets beyond just owning U.S. large cap stocks. Again, been a great diversifying year this year. Fixed income rates have gone up. You're getting better yields than before. It's a great time to be able to match those longer term needs with those assets. We really like cash flow producing investments right now, and we're finding a lot of compelling opportunities to acquire great assets that are producing great cash flows. And last, but certainly not least, be prepared, stay flexible, have the ability to capitalize. If we see markets move lower, higher, or stuck in a range, I would even argue if inside the markets, you see a lot of those dichotomies continue to occur. So that's everything that we have going into the second half of the year. We certainly know it'll be an exciting one. If you have any questions, please reach out to us. We're absolutely looking forward to gathering with you and discussing some of these things in more details. Thanks so much for watching, and we'll see you next time.